Welcome to Illuminati Silver. We tell you the truth about silver. Today is Friday the 20th of September 2019, and we're going to attempt to explain, hopefully in simple but complete terms, as to what happened with the so-called liquidity crisis the Fed faced this week, and whether it's likely to be harmful or beneficial to the price of precious metals, such as gold and silver. So let's investigate. Much has been made this week by pumpers that the Federal Reserve found itself in the position of pumping in, pardon the pun, more than $200 billion into the financial system, suggesting that it is on the verge of collapse. And yes, their followers, like sheep, came out and repeated this charge. So let us address what did actually happen in the repo market, as it is called, and what its potential implications are. The repo market is vital in how Wall Street works, and is a major conduit through which investors big and small, including anyone who owns a money market savings account, could earn interest. The lenders of securities in the repo market are often hedge funds and Wall Street broker-dealers that have large portfolios, but need money to fund their day-to-day trading. The cash providers tend to be money market funds or other asset managers that want a place to invest their cash on a short-term basis at little risk. So, banks, hedge funds and other major financial players borrow money on a short-term basis to ensure their books are in order. Often these monies are borrowed overnight or one day or for relatively short periods of time, so as to ensure those businesses and funds do not experience liquidity problems. The borrowers typically offer government bonds or treasury notes or other high-quality assets as collateral, which they repurchase, plus interest, when they repay the loan, often the next day. These repurchase agreements give the repo market its name. This market exists to allow companies that own lots of securities, but are short on cash, to cheaply borrow money. And it allows parties with lots of cash to earn a small return, while taking little risk, because they hold the securities as collateral. So hopefully so far so good. Now the interest rate normally charged, known as the repo rate, is often closely aligned with the Fed funds rate, which up until Wednesday stood at 2% to 2.25%. Obviously, this has now fallen to 1.75 to 2% since Wednesday's interest rate cut. But on Monday, this repo rate rose to 5% and soared on Tuesday to as high as 10% in some cases. Now this market, to give you some idea of size, has $3 trillion changing hands each day, according to the US Office of Financial Research. So in simple terms, the reason the rate rose because there was insufficient liquidity or monies available, or as some people have put it, a funding crunch occurred. And in simple economic terms, when demand exceeds supply, the price goes up. Now, in order to fill this gap, the Fed intervened and put some $200 billion into the system by creating new reserves. Now, no one can exactly say, at this moment anyway, what happened precisely to cause that liquidity crunch. But two major activities did occur which seriously contributed to it. First, Monday was the deadline for companies to submit their quarterly federal tax payments, thereby sucking monies out of the system as they paid it to the Treasury. And secondly, the same day was also the day the Treasury Department auctions of $78 billion in debt were scheduled to settle, meaning that $78 billion of cash was turned into securities, thereby again sucking money out of the system. Now, these are the two best assessments by market insiders, but we would proffer a third additional contributing factor. The Fed has also been steadily reducing the overall supply of money in the market, aiming to get conditions closer to how they were before the financial crisis, and it is quite possible that they've overdone it. A miscalculation failing to allow for a double squeeze event, resulting in a repo rate surge. Now, there are also other factors which could have caused this too, including trading calculations which backfired. Priya Misra, head of global rate strategy at TD Securities, proffered the notion that there could have been, quote, an oil bet that went bad after the attack on Saudi Arabia, unquote. But she also notes that the repo market also showed signs of stress in April and December, suggesting an underlying structural issue, namely that the Fed has gone too far in reducing reserves. So what's the big deal? Well, firstly, the last time the Fed had to do this was just before the financial crisis in 2008, and a number of people are suggesting that this is a signal that a similar crisis is about to occur. Fear factor, spread by those with an incentive to create fear. Now, the Fed chair, Jerome Powell, conceded at the press conference on Wednesday that the Fed had not anticipated such a large spike in interest rates, despite warnings of a possible crunch, but added the words, quote, "We don't see this as having any implications for the broader economy or for the economic outlook, nor for our ability to control rates," unquote. Now, rates, the repo rate, normalized after the Fed's intervention, and frankly we believe someone took their eye off the ball with this one, which caused the problem in the first place. Now, to put this into perspective, the odd one-to-day liquidity squeeze is not totally rare. Of this magnitude, yes, but small ones do occur. Banks, and especially the Fed, have to assess how much liquidity is necessary within the system, trying to account for a myriad of possibilities and events. Too much liquidity and profitability is affected. Too little, and we witness the squeeze we have this week. It's not an easy task, but the Fed in particular has to be aware of these events and prepare for them accordingly. Stock markets, gold and silver, and other markets have not been duly affected. So should we all be that concerned? Not really. But should the Fed be diligent? Yes, absolutely. What this does show, however, is how finely tuned these markets have to be and are, and how even one miscalculation or two could lead to a degree of panic. And this should not be totally discounted, if you pardon the pun, from our bank of black swans. Thank you for listening. And just for information, as we speak, gold is currently standing at $1,503, silver at $17.80, the Dow Jones Index is up 63 at 27,158, and the dollar index is also up 0.25 at 98.5. So please do not forget to tune in to our gold and silver weekly update, which will be published tomorrow. And meanwhile, if you haven't already done so, please subscribe to this channel and press the bell sign so that you are alerted of any new videos as and when they are published. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.
Glory, glory, hallelujah.